It is hard to get somewhere if you don't know where you are in the first place. And with personal finance, it's just as difficult to set financial goals for the future if you don't know where your finances are currently. The best way to measure your financial standing is to figure out your personal net worth. Personal net worth is basically your personal finance bottom line. After taking into account all of your assets and all of your liabilities, what you end up with is considered your personal net worth. Essentially, a financial goal is a guide or map, if you will. A well-structured goal will depend on four major things: a clear definition of what you plan to accomplish, a basic understanding of what resources you'll need to make it happen, a written time frame for which you'll need to make it happen, and a simple outlook on how you plan to make your goal fit into your overall budget in life. There are four types of personal financial goals you can set in your life. Number 1. Short-term personal finance goals. These goals typically take less than 1 year to complete. These goals are usually extremely important, as many of your bigger goals will depend on your success with these short-term goals. These goals are also important because they build morale and increase your financial confidence. Suddenly, the larger goals don't seem so impossible. Short-term goals might include reading a finance book, beginning to track your finances with personal finance software, or even paying off a credit card. Number 2. Mid-term personal finance goals. These goals should take less than 5 years to complete. These goals can relate to your short-term goals. It means a short-term goal may be paying off your Visa card, and a mid-term goal is to have all of your credit cards paid off. Mid-term goals, as well as your larger goals, need to be tracked closely, as procrastination can often make mid-term personal finance goals very hard to accomplish. Number 3. Mid-long-term personal finance goals. These goals should take anywhere from 5 to 15 years to accomplish. These are people who have become totally debt-free from pursuing a mid-long-term goal. These goals sometimes evolve or change completely depending on life's priorities. And number 4, long-term personal finance goals. Long-term personal finance goals may take 16 years to a lifetime to accomplish. These goals deal with your retirement and leaving an inheritance for your children. Many people set long-term personal finance goals to have a personal net worth of X amount of dollars by a certain age. Long-term goals also change and evolve as people grow and their priorities in life change. You should review and evaluate your long-term financial goals at least once a year, maybe when you do your taxes. Reward yourself by completing financial goals. Smaller goals may be associated with smaller rewards, while the completion of larger goals may be rewarded with a family vacation. Have you ever needed money immediately? Maybe to fix your car. You were laid off from work or some other emergency, but you didn't have the money to cover it. What did you do? Maybe you had to borrow money from friends or family, or you had to take out a loan or a credit card. Emergencies such as these are very possible. It can cause a lot of stress and worry in your life. The best way to deal with money emergencies is to be prepared. If you build an emergency fund, when you have emergencies such as these, you will have the money to deal with them. You won't have to borrow money, which will only put you into debt. Well, what is an emergency fund? An emergency fund is an amount of money that you put to the side for emergencies. It can be any amount of money you want, but a good rule of thumb is usually about 3 to 6 months of your living expenses. For example, if you need to spend $2,500 every month for food, rent or mortgage, taxes, gas, insurance, and other bills, you should save and set aside $7,500 to $15,000. This might sound like a lot of money, but you don't need to save it all right now. It will take you a little while to build it up. How do you build an emergency fund? You should always be saving money. I don't just mean getting deals. There's a big difference between saving money at the stores and saving money in the bank. If you go shopping for clothes, you might spend $100 on clothes that cost $150 before. Sure, you saved $50, but you probably weren't planning on spending that anyway. You might still have spent more than you planned, and in the end, you didn't put any of that money in the bank. You need to make saving money a habit. Save a certain amount of money out of your paycheck every payday. You can do a certain percentage on a certain amount. For example, if you get paid every week and make $800 a week, you can put aside 10% every month, or maybe $100 every month. If you make pretty much the same amount of money every month, then it doesn't really make much of a difference. But it's up to you. There's a lot of different ways you save money besides this too. You can take the equivalent of what you saved on your grocery bill and save it, or you can take every $1 and $5 bill and save it. There are lots of different clever ways to save. The important thing is that you do save. Once you have your emergency fund, you will feel a huge relief. You don't have to worry about living paycheck to paycheck, and you don't have to worry about emergency expenses. Make sure that if you have any debt, you pay that off before you start building an emergency fund. Once you have your debt and emergency fund paid off, don't stop saving. Continue saving on a regular basis and invest the money. Put it towards your kids' college funds, your house, and retirement, whatever is most important to you. The most important word is finance is the word cash flow. If you want to be rich and wealth, then you need to pay special attention to your cash flow and be constantly striving to increase your cash flow. The definition of cash flow is the pattern of income and expenditures and the resulting availability of cash. The greater your cash flow, the richer you will become. More cash flow means you have more money to spend on the things you need or want, like cars, food, housing, technology, etc. And it will also provide you more available cash to invest to future increase your cash flow. One of the things that defines whether or not a person will become rich is this word, cash flow. Rich people are constantly seeking to increase their cash flow, and by doing so they become richer and richer. Poor people don't give any thought to the word cash flow, and thus they are constantly buying liabilities that decrease their cash flow. Know where your money goes. Knowing where you spend your money is really important, because then you can look at the areas you are wasting money and you can find out how to spend less so you can have more money to invest to increase your cash flow. It is a great idea to have a budget that you follow. This will help you manage where your money is being spent. It can also be helpful to document every dollar you spend for a few months so you can see where all your money is going and how you can better manage your cash flow. Seek to increase your cash flow. Rich people are always looking for ways they can increase their cash flow. The best way to do this is to increase your passive income, the income you don't have to work for. If you can increase your passive income, then you can work less and earn more. So one of the best ways to manage your cash flow is to look for ways to increase your cash flow. It might be through a business. It might be through stocks, bonds, or mutual funds. It might be through real estate. It might even be through working more for your work. Whatever your situation, I am sure there are ways you can personally increase your cash flow. You just need to start looking. Cash flow is essential if you want to become financially free. In order to stop working, your passive income needs to be greater than all of your expenses. Becoming financially free in just 5 years is possible for anyone. It doesn't matter what your current financial situation is, you can become rich and never have to work again in just 5 short years. You don't need a high-paying job or a get-rich-quick scheme. You just need real training on creating real strategies for getting rich. Many people avoid personal budgeting for a couple of reasons. First of all, we are all busy, and creating a personal budget takes time. Unless we realize how valuable it is for us, we will likely procrastinate or just not do it at all. Another reason is that people may think they lack the skills to do it. Nothing could be further from the truth. These days, with all the financial templates available, you don't even need to add and subtract, but you do need to be organized and have your paperwork available to you. How to prepare a personal budget. The first step in preparing a personal budget is getting historical information. To this end, you will need to gather your bank and credit card statements, your cash receipts, your most important bills, such as insurance policies, major repairs, etc. The second step will be to process this historical information in some structural way. A good example of it would be a well-designed personal budget template. It would have the typical household income and expense categories, which would help you not forget some major areas of expenditures. From my own experience, I know that some expenses are hard to estimate. I was once shocked to see how much I was spending on food. The way I found out was by adding my receipts from all the grocery stores I go to, including the farmer's market, my specialty internet food orders, etc. So it could be that you will need to start collecting your receipts for a couple of months before you can actually create your budget. But it will be worth it, I promise. Don't forget annual expenses. Remember to take into account things you pay for once a year. They will not show up on your bank account until they are due. Things like insurance premium, car registration, membership dues, etc. Need to be divided by 12 and allocated to your monthly budget. Remember about repairs and maintenance. Have you allocated something to repairs and maintenance? Many of the things we own unfortunately keep breaking down. You will need to make an estimate for repairs and maintenance and include it in your budget. This is not something that can be easily based on the past. Even if your personal budget doesn't look perfect the first time around and you do not find ways to meet the targets you had in mind, keep at it. You have started the process, and that's what budgeting really is, a process. You know so much more about your own situation now than before you sat down to do this. Being in control of your finances has begun for you. Debt management is just one of a number of options available to you when facing serious debt problems. These options should be looked at and considered so that you can decide which option is right for your circumstances. Debt management is a term which denotes managing a borrower's debt. There are many factors which might have been influential in your debt. Debt management is not a quick fix to stop this happening. Debt management is one of a number of debt solutions available for people struggling to pay off their debts. Debt management is nothing to be worried about. For example, most people need a mortgage to buy a house. It could be unreasonable to think that we should buy our homes with savings. Therefore, debt is inevitable. Debt management is the process by which your debts are consolidated into one lower monthly payment. The one payment will be amount where you can afford and will be apportioned amongst your creditors. Debt management is not a term that most of us want to think about. Debt management is a system which will allow an individual or family to pay their creditors. All your unsecured debts are calculated along with your monthly outgoings. Debt management is the most effective solution to dealing with unmanageable debts. If we stop demands from creditors, help you regain control of your finances and create a single affordable monthly payment. Debt management is an option available for people with high outgoings who are struggling to manage their repayments and can't get a loan to consolidate these. By utilizing a debt management scheme, you are able to cut your monthly outgoings by up to half and only make realistic payments. Debt management is a way out of trouble for many people that is seeing a rise in popularity. From a finance professional's point of view, it can be the best advice for a client and also an additional income stream from otherwise declined or rejected mortgage inquiries. Individuals may borrow more money to be able to pay creditors or bills. However, this is not usually the best thing to do. The most common thing to do is to try and ignore the problem, but this will not make it disappear. Individuals usually get into a debt problem because they are living beyond their means and supporting their spending habits with credit cards. A debt consolidation loan may appear to solve things by paying off the existing debts, but unless this loan is affordable, it can lead to even more trouble. The most effective way to debt management solution is to control the expenditures and increase your earnings. To keep the debts under control, you should rely more on cash transactions rather than using your credit card debts. As credit card debts carry a high rate of interest, it is better not to use credit cards on a regular basis. The more you cut down your expenses, the more you save, which helps you in managing your debts in an efficient manner. Having a retirement savings plan is essential if you want to have a safe and secure life after retirement. But the problem is the current situation when you are not very sure about the different retirement plans and do not know which one would be the best for you. There are different choices available for the individual, and we would. Let's find out how should one go about starting these retirement savings plans. To get started, it is advisable that you make intelligent use of the money you are earning during your younger days. At least 10% of your earnings should be allocated for such retirement plans. This would, though, become very difficult if you have lots of bills and debts to meet on a monthly basis. But still, it is advisable that you consider only 90% of your income as your actual income. And try to manage your monthly expenses with the help of this 90% of the salary. This might be difficult initially, and you would find uncomfortable to operate in the initial months. But after a few months, everything would become normal and you would no more feel the pinch. One of the biggest advantages of this self-retirement plan is the discipline that you would inculcate in your spending habits, and the amount of peace of mind and security that you will get with the feeling of having saved some money is well worth the money saved. People would stop worrying about money and they would have a much better sleep at night. The 10% might look like a steep ask to step aside as savings. But if we look into our expenses and payroll, we would understand that the 10% is not that huge at all. If we decide to get rid of unnecessary expenditures that we make on a monthly basis, most of the expenses that you would do monthly would be for your personal needs, and they could be easily terminated if we are willing to. Look at the list of suppliers and vendors who are there in your expense list. Get rid of the ones who you think you can live without and the absence of whom will not affect your quality of life. If you spend a lot of money on partying and on entertainment, then cut the money on that front too. If you are partying weekly or going to the movies on a weekly basis, then make that once in 2 weeks, and if possible, make it once a month. The more the gap in your parties are, the less difficult you will feel to manage or run your family with 90% of your income. Money is very important in one's life, and is therefore very necessary that the person knows how to save them more than how to earn them. It does not matter how much love you spread in your family, as it would not be experienced unless and until you have enough money running in your family circles. Therefore, it is important that one takes savings this money seriously and secures their life after retirement. It's all the more important today that you maintain a strategic edge in terms of dealing with your taxes the most efficient way. Strategic tax planning has been proven to be most effective, a process used to reduce taxes for both individuals and businesses. Strategic tax planning can help you greatly when planning is done well before the end of the year. The urgency of dealing with your taxes now being the best time is important in the process of strategic tax planning. Now, understand your goals. Even as a business owner, when you do your tax planning, you do that at both the individual and business level to minimize your income taxes and save yourself money you need to grow your business. Remember, effective tax planning is about wealth management. To get through the process of tax planning in the most effective way, you start your planning by first understanding what your goals are and your overall business strategy. You then seek opportunities to minimize tax liabilities. You have to be proactive with your planning in the sense that you endeavor to understand your tax situation long before payment and tax returns are due. Endeavor to reduce your adjusted gross income. Your adjusted gross income is key in determining your tax bill. Adjusted gross income is the most significant measure of your net income minus any adjustments. The point is, the more money you make means the more taxes you pay, and the less you make, the less taxes you pay. So here is what you can legally do to reduce your income you make: contributions to a retirement plan. When you contribute to a retirement plan is what is factored in that reduces your gross income, and that way you will see a lower tax bill. You can also make adjustment to your income by making contributions to an insurance and other tax-saving plans. Keep track of your expenses. Another feature of strategic tax planning is by increase of your tax deductions from your taxable income. After you've reduced your adjusted gross income by any deductions and exemptions you may have, this is the essence of strategic tax planning. You keep track of your expenses throughout the year. Any of those personal finance programs online can help you track your expenses, which you can itemize when you file your taxes. There are a few good user-friendly programs online such as QuickBooks and Mint. The itemized deductions you should be tracking throughout the year include personal property taxes, state and local taxes, mortgage interest, expenses for healthcare, and gifts to charity. When you have a handle over your itemized deductions, your standard deduction and personal exemptions will now be determined based on your filing status and how many dependents you have. If you are totally clueless on how to perform personal tax planning the smart and legal way, you can spare yourself the agony by hiring a professional tax planner. He or she will be able to help not just by making you pay less, but also by promoting better understanding of how the system works. The purpose of estate planning is to help you achieve your personal and family goals after you pass away. It ensures that your assets will end up in the hands of those people whom you wish them to go to, so that you can reach your personal and financial goals even after you die. You also can reduce the amount of taxes paid by planning your estate in the right way to ensure that your heirs receive a larger inheritance. The saying that the only two sure things in life are death and taxes has existed for centuries. While no one likes to think about dying, it is a certainty and something that must be faced. A plan for your estate consists of a set of documents that help you plan for taxes and death, and it is something that nearly everyone needs, regardless if their financial and familiar affairs are complex or simple. The documents that make up an estate plan help you avoid problems that often arise upon your death. Many of these are problems most of us never think about during our lifetimes, or are things that we simply choose not to think of. But if there is no plan in place, these issues are handled by the courts. It is therefore very important to have a plan in place so that you can decide for yourself the best choices for your family, such as who will care for minor children, who will receive your property, and who will finalize your affairs. Estate planning can be a rather complicated matter. It does not require good judgment to ensure that you achieve the outcome you desire. It gives you the choice while you are alive to determine who, what, when, where, and how your estate will be handled. It also allows for substantial savings when dealing with tax issues, court costs, and attorney fees. Building your estate also helps your loved ones avoid the burden of having to deal with bureaucracy and confusion after you pass away. Unfortunately, many people do not plan their estates because they believe that they don't need an estate plan, or they believe that their family members can handle the task of dividing up their assets. However, if you fail to have a solid estate plan in place to handle the settlement of your affairs after you die, the laws in your state will determine what must be done. This may result in family disagreements, assets going to the wrong people, and liability for estate taxes that could have been avoided. Planning an estate can be a bit overwhelming. However, a reputable estate planning attorney has the knowledge and experience necessary to guide you through the process while keeping your interests and wishes in mind. When you have a good plan in place, you are giving the peace of mind knowing that all of your affairs will be handled as you wish after you leave this earth. Many people feel overwhelmed when they think about improving their finances. However, personal finances don't have to be complicated or painful. If you take the time to learn where your money is going and figure out where you want it to go instead, you should be able to improve your finances fairly quickly. Just because the economy is down, do not stop investing money in your mutual funds or other retirement accounts. While it may be a little tempting to stop investing at that time, you have to keep in mind that sometimes more money is made at the bottom of the market than at the top. Think about moving to a different area. Life is more affordable in certain states than others, and you might have better job opportunities in another part of the country. Think about this decision carefully and compare different factors such as the price of housing and the job market before you move. Do not put all your eggs in the same basket. It is safer to keep your savings in different accounts and to create a diverse portfolio of investments. Do not put all your assets in your name. Share them equally between you and your spouse. If something should happen, this is the best way to guarantee you will not lose everything you owe. Try to avoid using credit cards to pay for gifts. If you have good friends and family, you should understand if you are not able to buy them anything too extravagant. Making them something or offering them a service to make their lives easier may be worth more than anything you can buy. When it comes to driving, you should save a lot of money by finding shortcuts. Sitting in traffic or driving out of the way is just going to use up too much gas and in turn cost you large amounts of money. Check online maps to look for these shortcuts. Always keep any receipts and bank statements to make sure that everything is accurately recorded. Sometimes mistakes are made in the computing systems that only you will notice. Take personal responsibility for your finances instead of hoping that someone who works at the banking system will notice what happened to you. This might seem painful, but if you want to save money, cut out monthly cable. This could save you $700 yearly or more, and it forces you to engage in more productive and healthy forms of entertainment again. Go outside, read books, and interact with your family for entertainment. If you want to have good finances, you need to think differently about how you spend your money. Many of us see money as a way of enjoying life in the now, without realizing that there is also a value in enjoying life later. If you do not learn to save your money, you will not have money when you need it when you are older. Personal finances don't have to be overwhelming. If you take the advice that you have, watch this video and run with it, you can turn your financial situation around. Just look honestly at your finances and decide what changes you want to make so that soon you can enjoy the benefits of improved finances. It seems like there is no limit these days to the ways that people can get themselves into trouble financially. Running up credit card bills and taking out mortgages that leave your house poor are common mistakes that consumers make. You must need to avoid 5 personal financial mistakes and you will be fine. Number 1, running up credit card bills. The biggest personal financial mistake that people make is buying items on credit that they cannot afford. The country is paying the price right now of consumers who have put thousands of dollars on their credit cards and are now struggling to pay them off. Number 2, failing to save. Budgets are so tight these days for many American families that they are finding it difficult to save any money. However, you should treat your savings like any other monthly expense and put a specific amount of cash away. Most companies will let you split your paychecks between direct deposits so you can have some cash put into savings and the rest into your checking account. Think of it as paying yourself. Number 3, poor accounting. Do you have a budget? Too many people have no spending plan and could not tell you where their money goes each month. Write down how you spend your money each month and use that information to draw up a budget. Number 4, being house poor. A common personal finance mistake that is repeated far too often is homeowners buying more house than they can realistically afford. Sure, you may be able to afford a $2,000 monthly payment on your dream home, but can you afford the utilities and upkeep? Number 5, missing opportunities to save. Now more than ever, it is important to make your dollars stretch farther. One way that you would be able to achieve significant savings each month is through bundling services like cell phone, internet, and cable. Providers are offering great deals if you will do business exclusively with them. Being successful with the money you have is not easy or quick, and there are no shortcuts. Continue to educate yourself about financial matters and obtain and follow a financial plan. If you work hard to achieve the goals laid out in your plan and avoid these mistakes, you'll be well on your way to funding your dreams. If you found this video helpful, then do like, share, and subscribe to get future videos. Don't forget to press the notification bell so you don't miss our new videos. Thanks for watching this video. See you in the next one.